There's a game being played with Bitcoin right now, and if you own any, you're sitting at the table whether you know it or not. November 2024. Bitcoin hits $104,000. BlackRock's got their ETF approved. MicroStrategy just bought another billion worth. Institutional adoption, they said. Wall Street finally gets it, they said. And now, 3 months later, you're watching it bounce between 85,000 and 98,000. Asking yourself the same question everyone who bought at the top asks. What the hell happened? I believed the story. I did the research. I understood scarcity. I saw the ETF inflows. So why does this feel like I got played? My name is Charles, and I've spent the last 2 weeks digging into something that started as conspiracy theory noise on crypto Twitter and ended up being the most disturbing financial mechanism I've come across in years. And I need to show you what I found, because if you own Bitcoin, if you're holding through this volatility thinking it's just normal market cycles, you need to understand that there's a legal, documented, 100-year-old playbook for suppressing asset prices that's potentially being deployed right now. Not by hackers, not by some shadowy cabal. By banks. Using structures so boring-sounding that most people never bother to learn how they work. And that's exactly why they work. So if this explanation saves you from panic selling at the worst possible time, or if it helps you see what's actually happening behind the price charts, hit that subscribe button and give this video a like, because what I'm about to walk you through doesn't get taught in any finance class, and it should. Here's what makes this whole thing so insidious. It's not illegal. There's no crime being committed, no fraud, no manipulation in the technical sense. Just financial engineering deployed so precisely that it creates outcomes that look identical to manipulation without crossing any legal lines. And before you think this is tinfoil hat territory, let me take you back to 1982 and show you how this exact playbook destroyed entire countries. Mexico borrows billions from international banks. Smart move, right? Build infrastructure, fund growth, invest in the future. Except the debt was denominated in US dollars. Not pesos, US dollars. Which means Mexico doesn't control the currency they owe. They can't print more dollars. They can only earn them through exports or borrow more to cover existing debt. So when the US Federal Reserve cranks up interest rates to fight inflation in '82, suddenly Mexico's debt payments explode. The dollar strengthens, the peso weakens. And Mexico finds itself owing $80 billion with no realistic way to pay it back. So what happens? The IMF steps in with a rescue package. Sounds good until you read the fine print. Structural adjustment, they call it. Mexico has to privatize state-owned companies, cut social spending, open markets to foreign investment, sell pieces of the country to pay back the banks. And this wasn't unique. Argentina, Brazil, Indonesia. Dozens of countries over the next few decades, all caught in the same trap. Borrow in a currency you can't control. Watch external conditions shift. Lose sovereignty over your own assets. That's called a debt spiral. And here's what most people miss. The exact same mechanism that crushed nations applies to companies. And right now, there's a publicly traded company holding over $60 billion worth of Bitcoin, structured in a way that makes them vulnerable to the exact same trap. Let me give you something closer to home so you feel it. You own a house worth $500,000. You take out a home equity line of credit for $100,000 at a variable rate. Rates are low right now, so you're paying $400 a month. No problem, then the Fed raises rates. Suddenly you're paying $900, then $1,200, then $1,500 a month, and your income hasn't changed. What do? You've got 3 options. Sell the house, refinance and take on more debt, or default and let the bank take it. Here's the trap. The moment you start worrying about making payments, you start making desperate decisions. You might sell at a loss just to avoid default. You might refinance at terrible terms just to buy time. And the bank that lent you that money is sitting there knowing you're stuck. That's financial pressure without financial crime. They didn't do anything illegal. They just created a structure where your interests and theirs are misaligned, and when conditions change, you're the one who gets crushed. Now scale that up. Instead of a house, it's 60 billion in Bitcoin. Instead of a home equity line, it's 16 billion in convertible bonds and preferred shares. Instead of some homeowner, it's MicroStrategy, the largest corporate Bitcoin holder in the world. And instead of the Fed, it's the banks who lent them the money and might have an incentive to see Bitcoin's price drop. You see where this goes. Let me be clear about something before we go further. This is education and entertainment. I'm not a financial advisor. I don't give investment advice. You need to consult a licensed professional for your own situation. But what I can do is show you the mechanics of how this structure works, because once you see it, you can't unsee it. So here's what MicroStrategy did. They borrowed billions of dollars to buy Bitcoin. But they didn't just take out regular loans. They issued convertible bonds. That's debt that can convert into company stock at a predetermined price. And they issued preferred shares, which sit between debt and equity with specific conversion terms. Now, here's where it gets interesting. When you issue convertible debt, you're essentially giving the buyer two things: a bond that pays interest, and an option to convert that bond into stock if the stock price goes up. So, if you're a bank or a hedge fund, and you buy these convertible bonds, you profit in two scenarios. Scenario 1, the stock price goes up, you convert, you own shares at a discount. Scenario 2, the stock price stays flat or drops, you still collect interest on the debt, and the company has to keep paying you. But there's a third scenario most people don't talk about. You can hedge your position by shorting the stock. Here's how it works. You buy the convertible bond. That's your long position. Then you short the underlying stock. That's your bet that the price will go down. Now you're market neutral. You don't care which direction the stock moves because you're hedged both ways. But here's the twist. If the stock price drops far enough, the company might run into financial trouble. And if the company runs into trouble, they might be forced to sell their Bitcoin to raise cash. And if they sell Bitcoin, the price of Bitcoin drops. And if the price of Bitcoin drops, you can cover your short position at a profit while still holding the convertible bond that's collecting interest. You didn't break any laws, you didn't manipulate anything, you just positioned yourself to profit from the company's distress. That's called convertible arbitrage. And it's completely legal. Now, let me introduce you to the concept of a death spiral. A death spiral happens when a company takes on debt with conversion terms that create a feedback loop. The stock price drops, which triggers conversion at a lower price, which dilutes existing shareholders, which causes the stock to drop further, which triggers more conversion, which creates more dilution, and around until the company either collapses or is forced to sell assets at distressed prices. The term death spiral comes from something called a death spiral convertible, which is a specific type of financing that was popular in the late 1990s and early 2000s. Companies would issue convertible debt to raise cash, but the conversion price wasn't fixed. It was variable, tied to the market price of the stock. So, as the stock dropped, the conversion price dropped with it, creating more shares, more dilution, more downward pressure. This structure destroyed hundreds of companies. I'm talking about billions of dollars in shareholder value wiped out because investors didn't understand the mechanics until it was too late. The Securities and Exchange Commission eventually cracked down on the most egregious versions of these instruments, but the core concept never went away. It just got dressed up in more sophisticated language. Now, here's where we need to talk about MicroStrategy specifically. Their convertible bonds are not technically death spiral convertibles. The conversion price is fixed, but that doesn't mean there's no risk. Because the banks and hedge funds who bought those bonds have other tools. They can short the stock, they can use derivatives, they can apply pressure through the credit markets. And all of that creates an incentive structure where certain players benefit if MicroStrategy's stock price drops. Let me walk you through the numbers so you see how the pressure works. MicroStrategy holds approximately 447,000 Bitcoin as of January 2025. At current prices around $90,000, that's roughly $40 billion in Bitcoin, they have about 16 billion in debt. So, their net asset value, Bitcoin minus debt, is around 24 billion. But their market cap, the total value of all their stock, fluctuates between 30 and 40 billion depending on the day. That means investors are paying a premium to own MicroStrategy shares compared to just buying Bitcoin directly. Why would anyone do that? Because MicroStrategy is using leverage to amplify Bitcoin exposure. They're borrowing money at relatively low rates to buy an appreciating asset. If Bitcoin goes up, shareholders make more than they would by just holding Bitcoin. But if Bitcoin goes down, that leverage works in reverse. And here's the trap. If Bitcoin's price drops significantly, MicroStrategy's net asset value drops. If their net asset value drops below their market cap, the premium disappears. If the premium disappears, investors start selling the stock. If investors sell the stock, the price drops further. And if the price drops far enough, the company might face a liquidity crisis where they have to sell Bitcoin to service debt. That's the debt spiral. Now, I need to pause here and acknowledge something. I can't prove that banks are actively trying to trigger this spiral. I don't have access to their internal trading strategies. I don't know what positions they hold or what their intent is. But what I can show you is that the incentive structure exists, the mechanisms exist, the historical precedent exists. And the outcome? Bitcoin's price staying suppressed despite massive institutional adoption is exactly what you'd expect if this playbook were being deployed. So let me give you a different historical example to show you how this works in practice. In the early 2000s, there was a financing technique called a PIPE deal, private investment in public equity. It sounds boring. It is boring. But here's what it actually did. A company needs to raise cash fast. They go to a hedge fund and say, "We'll sell you shares at a discount to the current market price." The hedge fund says, "Great, we'll buy $10 million worth at a 20% discount." So, if the stock is trading at $10, the hedge fund gets it for $8. But here's the trick. The hedge fund doesn't wait for the deal to close. The moment the deal is announced, they start shorting the stock. They borrow shares and sell them at $10. Then they wait. The stock price drops because there's now selling pressure from the short position and uncertainty about dilution from the new shares. By the time the deal closes, the stock is trading at $7. The hedge fund covers their short at $7, making $3 per share. Then they take delivery of the discounted shares at $8, and they sell those at whatever the current price is. Maybe it's back up to $8.50 or $9. They profit on both the short and the discount. The company got their cash, but they paid for it by letting the hedge fund extract value from existing shareholders. This happened hundreds of times in the early 2000s. Companies like Krispy Kreme, Corning, and dozens of biotech firms got destroyed by PIPE deals with hedge funds who shorted the stock into the ground. It was legal. It was documented in SEC filings. And most retail investors had no idea it was happening. Now, fast forward to today. MicroStrategy issues convertible bonds to buy Bitcoin. Hedge funds and banks buy those bonds. Those same institutions have the ability to short MicroStrategy stock and to use derivatives to bet against Bitcoin's price. The structure is different from a PIPE deal, but the incentive is the same. Profit from volatility. Profit from leverage. Profit from the company's distress, if it comes to that. Let me give you one more example, and then I'll show you what this means for you as a Bitcoin holder. In the late 1800s and early 1900s, the Ottoman Empire borrowed heavily from European banks to modernize. They built railroads, upgraded ports, funded military expansion. And just like Mexico in the 80s, that debt was denominated in foreign currency. Gold-backed francs and pounds, currencies the Ottomans couldn't print. So when the empire faced economic pressure, they couldn't inflate their way out. They had to pay in gold. And when they couldn't pay, European banks took control. They installed financial advisors who had veto power over Ottoman budgets. They took over tax collection in certain provinces. They essentially turned the Ottoman government into a debt collection apparatus for European creditors, and this went on for decades until the empire finally collapsed after World War I. Now, I'm not saying MicroStrategy is the Ottoman Empire, but the mechanism is the same. Borrow in a currency or instrument you don't control, face external pressure, lose autonomy. And in MicroStrategy's case, that external pressure comes from the price of Bitcoin. If Bitcoin drops far enough, they lose options. They can't raise more capital by issuing stock because the stock price is down. They can't refinance debt on good terms because their assets are underwater. They either have to sell Bitcoin, which drives the price down further, or they default on their debt, which triggers a cascade that everyone's been trained to fear. So, what's the counter-argument? What if I'm wrong? What if banks aren't trying to manipulate Bitcoin's price through MicroStrategy? Let me give you the bull case, because it's worth considering. MicroStrategy's CEO, Michael Saylor, is a true believer in Bitcoin. He's been vocal about his long-term conviction. The company has enough cash reserves to service their debt even if Bitcoin drops to 60,000 or lower. Their convertible bonds have maturity dates spread out over several years, so there's no immediate liquidity crisis. And most importantly, Bitcoin's long-term fundamentals haven't changed. Limited supply, increasing adoption, institutional inflows through ETFs. If you believe Bitcoin is going to 150,000 or 200,000 or higher over the next few years, then short-term price suppression is just noise. It's an opportunity to accumulate more at lower prices. That's the optimistic case. And honestly, there's a lot of merit to it. But here's what I want you to understand. Both things can be true. Bitcoin can have strong long-term fundamentals, and institutions can still be applying short-term pressure to accumulate at better prices. In fact, that's exactly how smart money operates. They don't fight the trend, they create the conditions that let them buy low and sell high. And the way they create those conditions isn't through illegal manipulation, it's through structures that most people don't understand. Convertible arbitrage, short selling, derivatives, credit pressure, all legal, all documented, all designed to extract value from less informed participants. So let me connect this back to you. If you bought Bitcoin at $100,000, you're down roughly 10 to 15% right now. If you bought at $90,000, you're flat or slightly up depending on the day. And you're probably wondering, should I hold? Should I sell? Should I buy more? Here's my take. And again, this is not financial advice, just my perspective based on what I've researched. If you believe in Bitcoin's long-term thesis, decentralized money, limited supply, hedge against inflation, then short-term price movements driven by institutional games shouldn't change your strategy. In fact, if institutions are trying to shake out weak hands and accumulate at lower prices, that's actually bullish long-term. It means they believe in the value, or they wouldn't bother with the complexity. You don't engineer elaborate financial structures around assets you think are worthless. You do it around assets you want to own but don't want to pay full price for. On the other hand, if you bought Bitcoin purely as a speculative trade, if you don't understand why you own it beyond number go up, then this volatility is going to wreck you emotionally. Because this isn't the last time Bitcoin will drop 20 or 30%. This isn't the last time you'll see headlines about crashes and manipulation. This is the game. And the only way to survive it is to understand the rules better than the people trying to take your money. So here's the playbook. Here's what you actually do with this information. 1. Don't panic sell based on short-term price movements. Understand that volatility is part of Bitcoin. The question isn't whether Bitcoin will drop 20 or 30%. The question is whether the long-term fundamentals have changed. Has Bitcoin stopped being scarce? Have governments stopped printing money? Has adoption decreased? If the answer to all of those is no, then a drop in price is noise, not a signal. 2. Pay attention to MicroStrategy's quarterly reports. They publish detailed information about cash reserves, debt obligations, and Bitcoin holdings. If you see cash reserves running low, if you see them actually having to sell Bitcoin, that's a real signal. Until then, it's speculation. 3. Diversify your holdings. Don't put everything in Bitcoin. Don't put everything in any single asset. If institutions are playing games with Bitcoin's price, they might be playing similar games with other assets. Spread your risk. 4. Educate yourself on how financial markets actually work. Because the people who understand debt spirals, convertible bonds, short selling, net asset value, these people have an enormous advantage over people who just look at price charts and hope for the best. Let me tell you a quick story about something similar that happened in the gold market. Back in the 1990s, central banks around the world were selling gold reserves. The Bank of England famously sold half of Britain's gold reserves at an average price of $275 per ounce. The market called it the brown bottom, after Gordon Brown, the chancellor who authorized the sales. The official reason was that gold was a barbarous relic, doesn't generate yield. Better to hold dollars or bonds. But here's what happened next. Over the next 20 years, gold went from $275 to over $1,900 per ounce. The Bank of England lost billions of pounds in potential gains. Now, here's the conspiracy version. Some people believe those central banks weren't stupid. They were coordinating with private banks who wanted to buy gold cheap. The central bank sells, the price crashes, private institutions accumulate, and then the price goes back up. Can I prove that? No. But the pattern is there. Institutional sellers create selling pressure. Prices drop. Smart money accumulates. Prices recover. And the original sellers look foolish while the accumulators make fortunes. Is the same thing happening with Bitcoin right now? I don't know, but the incentive structure is there. The mechanism is there. The historical precedent is there. So here's what I want you to take away from this. The reason I spent 20 minutes explaining debt spirals in Mexico, pipe deals in the 2000s, and MicroStrategy's capital structure today is because these things are all connected. Financial engineering is a tool. It can be used to build wealth, or it can be used to extract wealth. And the scary part is, most people don't even realize it's happening. They just see their portfolio going down and think, I guess I was wrong about Bitcoin. But you weren't wrong. You were outmaneuvered by people who understand the game better than you do. Look, I'm not here to tell you Bitcoin is going to $500,000 next year. I'm not here to promise you anything. What I'm here to do is show you the mechanics of how large institutions can apply pressure to an asset through completely legal means, and how understanding those mechanics can make you a better investor. Because, at the end of the day, investing isn't about being right. It's about understanding risk, managing your emotions, and having the patience to let long-term fundamentals play out while everyone else is freaking out about short-term noise. So, what's going to happen with Bitcoin? I don't know. What I do know is this. If institutions are trying to accumulate Bitcoin at lower prices, that tells me they believe in the long-term value. If they didn't, they wouldn't bother with these complex financial structures. They'd just ignore it. The fact that there's all this pressure, all this drama, all these games being played, that actually makes me more confident in Bitcoin, not less. Because you don't engineer complex short attacks against assets you think are worthless. You ignore worthless assets. You engineer attacks against assets you want to own, but don't want to pay full price for. So, if you're feeling scared right now, if you're worried about your Bitcoin holdings, I want you to ask yourself one question. Do you believe in the long-term thesis? Do you believe that a scarce, decentralized digital asset has value in a world where governments are printing trillions of dollars? If you do, then short-term price manipulation shouldn't change your strategy. It should be an opportunity. And if you don't believe in that thesis, if you think Bitcoin is just a speculative bubble, then honestly, you probably shouldn't own it in the first place. Because this volatility, this manipulation, this drama, it's not going away. This is the game. And the only way to win is to understand the rules better than the people trying to take your money. Hit that subscribe button if this video helped you understand what's really going on. Drop a comment and let me know if you think this debt spiral theory is real or if I'm just connecting dots that don't exist. And most importantly, keep learning, Keep asking questions. Keep digging into how this stuff actually works. Because, at the end of the day, the best defense against financial manipulation is education. Know what you own, know why you own it, and know when someone's trying to play games with you. The real game isn't about Bitcoin hitting some price target next month. The real game is about understanding who benefits from volatility. Who has the tools to create that volatility, and how you position yourself to not get crushed when the pressure comes. And here's the uncomfortable truth that most people don't want to hear. The system isn't designed for retail investors to win. It's designed for institutions to extract value from retail investors. That's not cynicism. That's just reality. Every market structure, every financial instrument, every piece of regulation, it all favors the people with capital and information over the people without. But knowledge is power. And the fact that you made it to the end of this video tells me you're the kind of person who wants to understand the game, not just play it blindly. So use that. Use what you learned here. Apply it to Bitcoin. Apply it to stocks. Apply it to any asset you hold. Ask yourself who benefits if the price goes down. Ask yourself who has the leverage to make that happen. Ask yourself what incentives are at play. Because once you start seeing these patterns, you can't unsee them. And that awareness is worth more than any short-term trade. I'll see you in the next video.